we'll start with the proceedings for the day. And we are expecting some people who are on their way. In the meanwhile, I will just give a brief about the company, and we can introduce ourselves to one another to get familiar with the people and get a big start to the session. My name is Amresh, and it gives me enormous joy as it is my privilege to welcome one and all of you to this commodity price risk management workshop for automotive industry. Actually, this day is a culmination of our sincere efforts towards having an industry initiative with an aim to impart knowledge and share our success stories with an august gathering as yours. To give you a slight brief about our company, that what exactly TransGraph is all about, I would take a couple of minutes. As in, our company comprises of two words, that is trans and graph, and it has its own meanings. Trans means across and beyond, and graph signifies definition and quantifies the trends and relationship among variables. TransGraph services, products, and overall solutions are well defined, and the team strives to service and produce results beyond the defined limits. TransGraph provides knowledge-empowered decision-enabling solutions. We, TransGraph, are an independent, unbiased research and consulting company that specializes in market analysis and price forecast, price and risk consulting, and value chain studies. TransGraph's flagship software product, TransRisk, is a multi-dimensional market risk management solution focused on commodity industry. TransGraph's basket of reports, consulting services, and software products are widely used by leading companies spread across 28 countries, encompassing plantation, trading, FMCG, automotive industry, metals, mining, to name a few. The return on investment which you can expect from any of the TransGraph services or the solutions can be well quantified based on the delivery, that is process oriented. With the vision to create a world-class business with rich knowledge, resources, and efficient servicing abilities, Mr. Nagaraj Meda, who is along with us, as with deep passion and a small but a potent team, started TransGraph a decade back. In these years, we have surpassed many milestones and have created standards in the commodity industry. Today, we are the largest independent commodity research desk in India, tracking more than 40 commodities and having clients spread across more than 25 countries. At this moment, I would like to extend a warm welcome to each and everyone present over here. I would try to level best to enrich and empower with you with our humble grasp on our line of discipline. Now, actually, I would like to invite Mr. Nagaraj, our Chairman and Managing Director for TransGraph Consulting, to take the things inside from the inside the role for the day. Thank you.
Thank you for coming in and for spending time. I'm sure we'll try our level best to make your time work. Okay. So I'll introduce myself, and then let's all introduce ourselves for 5 minutes and then take it forward from there. So as Amresh said, my name is Nagaraj Meda. I'm basically a qualified technical analyst. Okay. Technical analyst is the science which is used for charting and price forecasting. All commodity hedge fund based out of Singapore. And then subsequently, since last 8 years, I've been trying to bring in the best practices of the financial markets to the manufacturing side. And I have with me Murali Krishna. He's CEO of our consulting business.
Good morning to all of you. My name is Murali. I'm into commodity markets for the last 15 years. I've been trading the commodity markets. Started my career with trading in commodity derivatives. Into commodities in one way or the other for the last 15 years. I've seen the full life cycle. When I say life cycle, it is into operations, into back office, into middle office, into front office, which is trading. For the last 4 years, I am with TransGraph Consulting, trying to work out industry acceptable risk management solutions. In the last 4 years journey, I have interacted with various industry participants and have collected a lot of information from them in terms of what are the pain areas they are going through. Today's attempt is to try and summarize those pain areas, and I would request all of you to make this one as an interactive session. Though we are going to present from our side major part of today's session, I would request each one of you to question and understand the concepts which we are going to present today. This is one such occasion where we can establish the sync up between the industry and the best practices that are followed across. It is not necessary that this practice is followed in your particular sub-industry, but maybe followed in another sub-industry belonging to the automotive industry. So, I request you to have an open mind to evaluate this particular best practice and see if it is making sense for your business. So, as I said, please make this one as an interactive session, and request all of you to introduce yourself so that you can have some sync up later on as well.
Myself, Pradeep Shekhar. I am handling corporate sourcing from PG Industry Group.
Rajan from TVS Chopra.
I am Rahul Karamedkar from Purchase Bajaj Auto.
Good morning. I am Vijeshwar from Bajaj Auto.
Good morning, everybody. Myself, Gulshan Sani from Shriram Distance Purchase Department. Thank you.
I am Sanjay from Federal Purchase.
I had the purchasing in Federal Mobile.
Morning, I am Sagal from Petro-chemical Purchase.
It's Rashmi and I'm from NCX.
Good morning, I'm S. Bora from Denso, Procurement Department.
Hello, good morning. This is Manoj Vashnia from Escorts.
Good morning. I am Sangeet Oswal. I head development in Escorts.
Good morning. This is Prashant Agarwal from Continental Regions.
I represent business development team at TransGraph.
Our engagement manager, who is more into market analysis and tracking, he has in-depth knowledge of base metal markets, steel and polymers. Sunil Daga, he'll introduce himself.
Yeah, I am Sunil Daga. I have since past 11 years I have been in the financial markets. I was looking after equities. I had my own desk in Hyderabad. Since past 4 years I have been with the TransGraph, and I am heading the metals research and risk management division. Thank you.
So the way we have organized this one is mainly into 4 sessions. Okay, each session will be of 1.5 hours, and after 1.5 hours we will have a tea break initially, and then subsequently followed by 45 minutes lunch after the second session. And the third session will be again for 1.5 hours, followed by tea break, followed by the last session of 1.5 hours. So we're going to have some 6 hours of 6 to 6.5 hours of an interactive session, as Murli said. The first 2 sessions I am going to cover. I am going to cover basically I will be talking about what is the how the volatility has been impacting the commodities and so impacting the automotive industry, and trying to bring in a problem statement, and then I will try my best here to so that each of you would relate to these numbers from your own perspective. Okay, so we would encourage if you say when I say for the industry, raw materials as a percentage to the total sales ratio, say is X, but for you what it is. Okay, so you need to figure out. If you feel it is confidential, you can write for yourself. Okay, if you are open, you can share that. You can share that with the people. This is just an example. So like that, we will try and see what are the top 5 or top 6 metrics that we have to track to ensure that we are having risk management in place. Okay, so those top 5-6 metrics, I want you to think and then write on your paper, so that at the end of the day, those will be a key takeaways for us to manage going forward. Then subsequently, once we have the problem statement in place, we are going to propose a solution. The solution is broadly in terms of hedging and risk management. The name of the solution is hedging and risk management. So I will cover about what do you mean by hedging. So for hedging, you use financial derivatives. So the second part I am going to focus on what is the future, what is a forward contract, what is an option contract, and how do you hedge. Then the final part is I am going to take a couple of case studies and will bring out about how we have to bring in the hedge model in place, how we have to draft risk management policy for the company. Okay, and some kind of a screenshots and some kind of a case studies in that particular. With this, I would be concluding both the sessions. Okay, I would be the first session I will focus on completing until the concept of futures and hedging, and in the second session I will start with the options, volatility, and then the case studies. Then the third session after lunch, Sunil will be talking, Sunil Daga, who has just spoken with us. He will be talking about the price outlook on various commodities. Okay, he'll spend 1.5 hours detailing about economy and then the price outlook. And the last session will be taken by Murali Krishna, who will summarize using the price outlook, using the derivatives knowledge, and using the case studies that what we have discussed. How do we move forward, and what are, he will summarize so that we are in sync at the end. That will be followed by presentation from MCX angle by Rashmi, where she will explain what are the hedge avenues that are available within India, and what are the transparency and what are the mechanisms that are available with the MCX, with which we will be concluding the session. Okay. So to start with my session 1, okay. So this is a research output from TransGraph Research Desk. Here we have raw material expenditure. Okay. Here we have the raw material expenditure. The first part covers raw material as a percentage of total expenditure for automobile companies. Okay, for various years. So it has been fluctuating from 25% to 31% out of the total expenditure in automobile companies. 25 to 31% goes to raw material spending, and raw material as a percentage to the total sales for auto component manufacturers. Meaning, out of 100 crores that we do as a sale, how much of it is going for raw material in auto component companies? Okay, it fluctuates between 61% to 64% over a period of time. Okay, we have taken the data of some listed companies. Okay, and we have collated this particular index. This particular number for your company could be different. Okay, could be different, whether it is 60%, 50%, 40%, or 65%. Okay, you have to figure out yourself. Okay, because why this is very important, because the bigger this number is, that is raw material as a percentage to the total sales, the larger the impact it will make on your net profit margins. Here on the second graph we have net profit margins. Automobile companies have net profit margin of around 7-8%. Okay, this is after everything. Okay, maybe at a gross level somewhere between 15 to 20% before financial and tax expense. Okay, so net profit margins for automobile companies. This is the industry thing. Obviously, your company will have probably a greater margin. The industry average, what we can see in one of the years, that is in FY09, that is financial year 2008-9, we have seen this net profit margin going to almost 4.8%. Okay, so is there any relation between these two, that is raw material as a percentage to the total sales and to your net profit margin? Yes. So what are we saying? We are saying net profit for automobile companies is highly fluctuating and currently standing at 6.2%. Due to the high valuation in automobile companies, impact of increasing raw material spend has resulted into lower net profit margins. Lower net profit margins. And net profit margin for auto component companies is stable and currently standing at around 9.4% and is hugely driven by commodity price trends. So the more you spend on raw materials or commodities, the less your margin will be, is what I am trying to say. So, for example, we take some initiative. Okay, we carry forward from this particular meeting, and then we take some hedging and risk management initiatives and save 1% of your procurement spend. What does it mean for the company? Okay, 1% saving on commodity spend increases the net profit by 4.9% at industry level. 1% saving in your commodity spend will increase the net profit margins by 4.9% in auto component companies, whereas in automobile companies, 1% saving on commodity spend will result in improvement of 3.5% savings. Okay, this fluctuates on a year-on-year basis, but broadly we can say that between 3 to 5% we can make impact. 1% savings. So that's why I call this exercise of hedging and risk management. It's not a backroom job; it's a boardroom job. Why? Because we are impacting the profit margins. We focus some time and we take up the initiative, it is going to change the face of the company, it is going to change the profitability of the company. Okay. And in our experience,
how do you calculate this? How do you say that 1% RMC saving will?
Okay, I have an example here. Right. Like for example, say here this is a typical budget here. Okay. Here, marketing department sales projections based on the last year trends and industry and economic environment. That is number of units into sales value. Say they are projecting 1,000 as sales value. Okay, this is just an example. Okay, and these are the cost components. So you have raw material expenses, which is 300, and manufacturing 200, administrative, marketing and expenses. The total expenses are 800. So you make the budget this way. Okay, and then you want to have a gross margin of 200. After the financial expenses and tax, probably this could be 100, which is your net profit margin. So, most of the heads are predictable with risk management, with the raw material spend is not predictable at company level. Okay. Say, manufacturing expenses are fairly predictable, even the salaries you fix at the start of the year. Administrative operating overheads mostly are predictable. Marketing expenses are manageable. Okay. Are manageable because you fix the budgets and then accordingly you will execute it. Okay. But what is the most varying is this 300 time. For example, if you save 1%, say for simplicity, say 10% of 300. Okay. Then 10% of 300 is 30. Okay. So this 800 will become 770. Okay. So 30 on your 200, okay, is 15%. Okay. So the way I am calculating is 10% saving on 300, which is your raw material spend, is resulting into 15% improvement in the profit in this example. Okay. So similarly, we have taken the data of the companies of say the top 15 listed companies, okay, and we have constructed this sheet, okay, of what is the revenue and what is the expenditure and what is the sensitivity to this. Okay, so based on that, we are saying instead of saying 10% because 10% is much larger, I am saying that let's start with 1%. Okay, so 1% saving will bring in a net profit margin improvement or a gross profit margin improvement of 3.5 to 4%. So it is very important that because when you build the budget, you are actually the entire expenses are built based on the cost sheet which we have seen. Okay, so we should have that perspective that what work we are doing in purchase or sourcing, okay, is very strategic in nature. It is going to impact the bottom line of the company. Okay. So that's how I call this as a boardroom job. Now, this is again one more interesting slide. These are kind of escalating raw material prices is what we are going to talk about. Okay. What we have done is generally whenever we put your budgets, you compare it with last year. Okay. You compare it with last year. Whether last year is representative of your total business. Sometimes you would have lower prices in the last year. Sometimes you will have very higher prices in the last year. Okay. That is why we have built, say in FY07 we have taken 100 as an index, okay, as a base year. The way you calculate inflation, we say that the WPA index is the wholesale price inflation is 9.4%. How are we saying that 9.4%? It is indexed to a particular base year. Similarly, for auto component companies, also let's have this index. So this index which my research team has developed, FY07 they have taken as 100 and they have calculated two things. What are they? One is PCI, what we call as, that is Procurement Cost Index. Procurement Cost Index. And the other one is SPI, which is Sales Price Index. For an auto component company, what is your procurement cost index? So if your procurement cost is 100 in FY07, it has increased to 130 in FY08. And it has fallen to 129 in FY09 and 119 in FY010. And subsequently it has increased to 134 in FY011. Okay. So every year when you are making this 34% increment, you are not saying this 34% as compared to the previous year, you are compared to a base year. Okay. You are comparing it to the base year. So this is your procurement cost escalation. Okay, escalation or fall. As compared to FY10, FY11 has increased. Similarly, FY10 has fallen from 129, it has fallen to 109. Okay, so relatively, the prices of financial year 2010 or your procurement cost budget has fallen as compared to the previous year FY09. Okay, but this is more expensive than FY07. Okay, this is more expensive than FY07. Okay, this is the procurement cost. Okay, then what is the second part, which is the blue bar, which is the sales price index. Okay, means when auto component companies buys commodities, adds engineering to that, makes the components and sells to the OEMs. When they sell to the OEM, they have the price built in. Means they will give, okay, this is the raw material price, and that raw material price in the sales is also linked to markets. Okay, sometimes you might have a fixed price contract, sometimes you will link it to the market prices. So your sales price index, when I take FY07 as 100, then that has in FY08 it was 130, and 125, the brown bars, sales price index, 125, and then it has increased to 134 in FY09, and 126 in 10, and then 122 in FY11. Okay, what does this say? The down graph, the difference between the blue and brown, which is the difference between your purchase cost index and the sales price index. Okay, if you are having bigger blue bar, it means the auto component company is unable to pass on the cost escalation to the customer. Okay, if the brown bar is bigger, like in this year FY09, there is in sales realization you have 7.6% increment. Okay, and in cost escalation it is only 0%. So this year FY09, these companies, this auto component company would have made more money. Their margins have increased. Whereas in FY08, you have a 29.5% cost escalation, whereas the sales realization increment is around 4.5%. Okay, is around 4.5%. So here you are going to have more problem. Means you are not able to pass on the cost escalation in terms of the sales realization to the OEMs. Similarly, here on the recent graph, there is a 12.5% increment in the cost, which is on FY 2011. That is for 10-11 year, there is a 12.5% cost increment, and then the sales realization has not increased, it has dropped by 3%. Okay, it has dropped by 3%. It means you have a cost escalation and you are unable to pass on that cost escalation, and moreover you had a more negative hit. Okay, so it means we are inability to pass on the commodity inflation to the customers is what it signifies. Okay, how we collated this data? We took the procurement cost as well as the sales price realization from annual reports of 15 listed companies. Okay, we have taken battery manufacturers, we have taken some other component manufacturers, some 15 companies which are listed where their data is available, and we have calculated this particular thing. So, annual average procurement cost escalated by 12.5% in FY11, while average sales price dropped by 3% in the FY11. Okay, the reason for this is inflation in bulk commodities is becoming a major concern for us. And the inability to pass on this commodity inflation to the customer is what is the reflective of the FY11 strategy. Okay, FY11 number. So, what are we saying? Index from a base year instead of starting every year afresh. Please look at your cost from a particular base year, okay, and have some kind of a 4 to 5 year strategy. You also have compare with the previous year. Obviously, you will continue to follow that practice. As a add-on, you might consider indexing it to a base year so that you will have a kind of a perspective. That is point number 1, and take away from this. What is 1% savings impact for your company? If you say 1% on your raw material spend, how much percentage it will improve your net profit margin? Okay, I said it is 3.5 to 5%. Okay, for industry, but that will be some number. That number will be different for your company. Please calculate that and note down so that you will realize the importance of savings to that particular thing, and you will be able to drive in the willingness of the management to come and help you to take various initiatives initiatives so that they understand that okay, these guys say 1%, it's going to improve my profit margin by say 5%. Okay, in your company it could be 7%. I don't know. Okay, please write down that one, calculate that one. That is one. The second takeaway. The third takeaway is how has the procurement cost index and sales price index, if you are an auto component company, okay, how has the PCI and SPI, that is procurement cost index as compared to this year as we have seen in the previous slide, and sales price index as we have seen in the previous slide, has changed for your company over a period of 4 years. What am I saying? You please construct this graph, okay, you please construct this graph for your company, that is procurement cost index and sales price index. Then, if there is a differential between PCI and SPI for your company, it means you are unable to pass on the cost increments to your customer. Okay, so you will be able to know how much is the problem. If you are able to pass on the cost escalation to the customer, then this is not a major problem area for you. If you are unable to pass on that particular thing, meaning if your blue bars are bigger than the brown bars, that is your procurement cost escalations are larger than the sales realization in terms of the commodity, then you have a problem and you have to address it. Okay, the bigger the gap, the bigger the problem is, and the bigger the impact you can make. Every challenge is an opportunity for us. Okay, every challenge. Only thing is we have to identify the challenges and we have to put in place the right metrics to track those challenges so that we convert them into opportunities. And a bit controversial, are you tracking your suppliers PCI and SPI differential? So you have a supplier, okay, and if their numbers are available, you please track their blue bars and brown bars, that is your procurement cost index and the PCI and SCI, that is sales price index. If they are they passing on the benefits to you, or are they not passing? Okay. If they are making more money, obviously you can engage in bigger negotiation. Okay, so that you can get something. Okay. So while this is kind of okay, I know that in this room there are people who are suppliers as well as the buyers. Okay. But having said that, this is one of the best practice. When you are doing PCI and SPI index for you, you can as well do it for your suppliers. Okay. So there are crucial 5 takeaways from this particular thing. We are saying that please index from a base year instead of starting every year afresh, and what is 1% saving impact for your company, and how has the PCI and SPI has changed for your company over a period of 4 years, and if there is a differential between PCI and SPI, meaning if a cost is more than the revenue, then it is a matter of concern. You have to understand how do we address that. Second, are you tracking the last one, sorry, the fifth one, are you tracking your supplies PCI and SPI? Okay. Please write all these numbers practically for your company. Calculate and keep it, and maybe you can pin it on your dashboards. Okay. These are very, very important metrics. Now, having said that one, how practical is your budget? I have to excuse in the booklet that I have given, the slides might not be the same as this sequence because of the thought and some workflow I changed the sequence in the last minute, but we will be mailing you this presentation subsequently. How practical is your budget? Here we have percentage change in annual average prices of various commodities. Okay. So say for example steel, there is an annual average price. In FY08, that is for financial year 2008, that is 7-8, there is a 24% increment in annual average price of steel. Okay. And for rubber, there was 8% increment, for aluminum it is 0% increment, copper 8%, lead 1 or 2%. Okay. 1 or 2%. And the wholesale price index at the India level, the inflation number which we see was 4.7%. Okay. So typically, I have observed in most of the companies, okay, they make budget based on the last year. Okay. Last year, the average price was X. Okay. And the expected inflation at India level, which is this number, sorry. The expected inflation at India level is this number, 4.78%, 10%, and then you ask for some certain cost escalation. Is it realistic? Because if you see these numbers, like for example,